And welcome back. Home buyers are facing a lot of headwinds right now. Number one, of course, mortgage interest rates have been absolutely skyrocketing, increasing by over 400 basis points in one single year, or more than doubling over the past year. That's number one, of course, but it just got harder to qualify for a home loan. So I'm going to be sharing this report with you guys here in just a little bit. But also because we're having a decrease of home buying demand across the United States, home buyers right now are facing less competition amongst other home buyers when submitting offers. So in today's video, I'm going to share all the details with you guys. So if you guys get a lot of value in today's video, and of course if you do, please hit the like button. I greatly appreciate that. Also consider subscribing as well. I post frequent housing market updates so you guys can be more informed. I actually really enjoy making these videos as well. Anyways, let's talk about this right here. This is according to the Mortgage Bankers Association, or the MBA. They just announced this today, actually this morning at the time of this video, which is October 11th here. So they say here that mortgage credit availability decreased in September. This is according to their Mortgage Credit Availability Index, or their MCAI. So this is an index based on lending standards for home lenders. So it says here, their index fell by 5.4% in September. A decline in their index here indicates that lending standards are actually tightening. In other words, it becomes more challenging in order to get a home loan approved. In contrast, though, when this index actually increases, though, this is indicative of loosening credit. In other words, it gets easier to get a loan approved here. So we're seeing lending standards actually tighten for the past 7 months in a row now. It says credit availability fell to its lowest levels since March of 2013, the 7th consecutive month of tightening. In other words, lending standards are very, very strict. The strictest they've been since March of 2013. And I'll share some graphs with you here in just a little bit to share how availability of credit has changed over the past 10 years, and also more importantly, compared to 2014 to 2008 compared to now, which is pretty eye-opening. Stay tuned for that. And Joel Kahn, who's one of the MBA's associate vice presidents, stated the following here. With the likelihood of a weakening economy, which would lead to an increase of delinquencies, mortgage delinquencies, there was a smaller appetite for lower credit score and high loan-to-value loan programs. And he says here, as mortgage rates have more than doubled over the past year, that resulted in a drop of refinance activity. If you guys follow the channel, the amount of people submitting applications for refis has decreased by more than 80% compared to 1 year ago, just because mortgage rates have been increasing so much. So speaking of mortgage interest rates, according to Investopedia today, which again is the 11th, average 30-year fix is at 7.32%. That's averages for people with exceptional credit across the United States. So averages, of course, means you could get less than that, or you could get a rate actually more than that, depending on your lender and, of course, your credit worthiness, like your FICO score, for example. Also, according to the Mortgage News Daily, average rates right now at 7.14%. This is a new 20-year high, the highest rates we've had since 2002, which is absolutely insane. Because look at this, 1 year ago, rates were 3.17%, an increase by almost 4 percentage points compared to 1 year ago, or 397 basis points, which is just mind-boggling. So what lenders are doing right now is tightening their standards, which they have done for 7 consecutive months, because they're anticipating a weaker economy and, of course, for an increase of mortgage delinquencies. In other words, they're hedging their bets right now and tightening their lending standards and lending to borrowers who have higher credit scores, and they're getting rid of higher loan-to-value programs. But take a look at this, because here's their index over the past 10 years or so. So their index right now is 102.5. Look what happened at the onset of this pandemic. In January, more or less, of 2020, their index absolutely fell off a cliff. In other words, they became very, very tight in their lending standards because of the fallout of our economy and, of course, stay-at-home orders due to COVID. And the levels we have right now are actually the lowest levels since 2013. So the levels we have right now are about a 9-year low, which is indicative of tight lending standards. Also, as you can see right here, ever since really the fall and winter months of 2021, this has been decreasing greatly, again, down 7 consecutive months. But have a look at this, because when you compare this to 2004 up until now, it's very, very eye-opening here, because look at this. Here's the credit availability ever since 2004. which is right here. So in 2004, really until 2005, let's just say 2005 until 2006-ish, lending standards became very, very loose. Back in the middle or the early parts of 2006-ish, the index was just under 900. Right now it's 102.5. So lending standards right now, the lowest we've had since approximately 2013, and far below levels from 2004 all the way until 2007. I mean, back in 2005 to 2007-ish, you could get a loan very, very easily. As long as you can breathe into a mirror and there's fog, you get your loan approved. That was back in during the day where you could get a no-doc loan or an engine loan, where you don't have to provide any support for the income that you're stating. So you can say, hey, I make $100,000 a year. Your lender will just say, okay, that's good enough for us, and not ask for any documentation to support your claim that you actually made $100,000 per year. It was absolutely insane. So the lending standards right now are far tighter compared to the Great Recession, for example. Now, don't get me wrong, our current housing market has a lot of challenges. Number one, of course, would be, in my opinion, a lack of housing affordability, because mortgage rates have been increasing so much. And of course, home prices are still very high at a national level compared to historical standards here. So that's number one. We're seeing a lot of challenges in our housing market due to housing affordability. So despite the fact that lending standards are very, very tight, I'm not saying that our housing market is without its challenges. So I want to make sure that you guys are aware of that. Let's talk about bidding wars according to Redfin here, though, because they have a really interesting article that was actually published at the end of September, which I actually missed. But they really talk about how a lack of competition is seen across the United States, more or less, because home buying demand has been decreasing. So that's kind of the silver lining right now. Even though it's cost more to buy a house right now because of rising rates and, of course, home prices, at least a lot of home buyers right now are not facing a lot of competition amongst other home buyers when they're placing an offer to buy a house right now. So it says here nationwide, 44.6% of home offers written by Redfin agents face competition. The lowest bidding war rate since the beginning of this pandemic, when the housing market, of course, was ground to a halt. This is down from 63.5% from 1 year ago. So in one single year, the rate of homebuyer competition or bidding wars went from 63.5% to 44.6%. This is also the 7th straight monthly decline. So here's a chart showing the percentage of bidding wars ever since April 2020. That was when Redfin started tracking this data here. And this is the monthly share of Redfin home offers that face competition. And by the way, they define that as when a Redfin agent reported that it received at least one competing bid. So this August, the share was 44.6%. So the share of offers written by Redfin agents where they received at least one competing bid. That represented about 44.6% of the time. This is actually a typo here. Again, Redfin, I don't know what's going on. Anyways, August 2021, the rate was 63.5%. But look at April 2020, because the share was only 33%. Now it's 44.6%. So again, this is kind of like the silver lining with home buyers right now. Even though rates are so high, at least you don't have as much competition compared to 1 year ago, down from 63.5% that we saw 1 year ago. They also reported that a typical home in a bidding war received 3.2 offers in August. That's down from 5 1 year ago. It says here buyers are dropping out of this market and competition is dwindling, largely because mortgage rates have more than doubled from 1 year ago, reaching 6% in mid-September. Redfin agents also reporting that prospective buyers are really backing out because of high monthly mortgage payments due to sky-high mortgage rates. And some prospective buyers have also put off their housing market shirts altogether due to their thoughts regarding home values decreasing in the months ahead. Redfin also noted that San Antonio, Texas, Tampa, Florida, as well as Phoenix, Arizona were the metros with the lowest bidding war rates. So approximately 21.7% of home offers submitted by Redfin agents in San Antonio faced competition in August, the lowest share of the 36 metros in this analysis here. That was followed by Tampa Bay or Tampa, Florida, with the second lowest bidding war rate at 23.8%. That was followed by Olympia, Washington, Phoenix, Arizona, as well as Minneapolis, Minnesota. In contrast, though, Philadelphia had the highest bidding war rate at 61.7%. This is the highest rate in this analysis here, again, with 36 metros in this analysis here. That was followed by San Jose, California at 58%, Providence, Rhode Island, Boston, Massachusetts, and also Detroit. They also provide each city and how they fared compared to last month as well as 1 year ago, which I found to be really interesting here. Again, San Antonio, Texas had the lowest rate at 21.7%. So approximately 2 of every 10 offers that were written by Redfin agents face competition, at least one other offer. Compare that to 1 year ago. Look at this. The rate was 60%. So in 1 year, they went from 60% now to only 22%. So if you're a home buyer looking for a house to buy in San Antonio, Texas, chances are you're not going to face a lot of competition in order to buy a house. Much different compared to last year, though. In Tampa, Florida, 1 year ago, it was 54%. Now it's 23%. Look at this. Olympia, Washington, 61%. Now it's only 24%. And the list goes on here, pretty interesting here. Let's look at the lowest share, though, actually the highest share, I should say. Philadelphia, 61.7%, actually higher compared to 1 year ago at 60.2%. So maybe the market there is still remaining very competitive, given the fact that their bidding war rate is very, very high. San Jose, California at 58%, but last year it was 72.3%. Providence, Rhode Island at 55%, 60% last year. Let's take a look at anything else here. It's worth noting. San Francisco, 52.5%. 1 year ago, it was 70% though. And in Sacramento, where I live and work as a real estate agent, the rate right now is 45.5%, actually up from July's rate at 32.9%, but far below last year's levels at 65.5%. I can say in Sacramento 1 year ago, our housing market was absolutely insane. It was so challenging to get an offer accepted with a home buyer here in the greater Sacramento area. It wasn't uncommon for home sellers to get over 8 offers for a property. I had a house that I written an offer for where the home seller received about 15 offers. There was actually a house here in Citrus Heights, which is about a 15-minute drive from Sacramento, and the home seller there received 123 offers on one single house, which is mind-blowing. That actually made national news. In any case, I digress here. Other cities I want to mention here is Miami, Florida, which has been a market where it hasn't slowed down as much compared to other markets. So the bidding war rate is 42.2%. 1 year ago, it was 57%. Dallas, Texas is 42%. 1 year ago, 65.6%. Look at Nashville, 40%. Now it's 60%. Riverside, California as well. It was 67% 1 year ago. Now it's only 40%. And I'll scroll down here in case you guys want a screenshot and take a look at these other cities here. Also want to share the cities that had the highest rates 1 year ago. So I thought it'd be interesting to look at that. Look at that. Raleigh, North Carolina. What a difference that is. Wow. So Raleigh, North Carolina, 79% in August of 2021. Now it's only 35%. If anyone lives in Raleigh, North Carolina, let me know what's going on there. Maybe I should make a separate video regarding that because this is pretty eye-opening. 79% now to 35%. San Jose, we already talked about that. Los Angeles, 70%. Now it's only 50%. Look at Charlotte, 70% or 69%. Now it's only 31%. Pretty eye-opening here. San Diego also very high last year at 68%, and also Detroit at 68.1%. Pretty eye-opening stuff. I hope you guys got a lot of value out of today's video. And of course, if you did, please hit the like button and greatly appreciate that. Hope you guys have an awesome day and look forward to seeing you on the next video.